Good afternoon. This is Josh Mindlin here at Chaikin Analytics, and I'd like to welcome you to our presentation of Turn Volatility into Profits, How to Trade Options for Big Profits Right Now. Presenting today is Marc Chaikin, founder and CEO of Chaikin Analytics. As a reminder, this webinar is being recorded and a copy will be sent to all registrants. Please submit your questions via the Zoom Q&A window, which you can access in the upper left-hand corner of your screen. During today's webinar, we have a special edition, which we don't normally do. Marc will go live on our platform and give you a look at the ease of use in practice. Now, to get us started, here is Marc Chaikin.
Thank you, Josh, and welcome everybody. If I sound a little more relaxed than usual, it's because Sandy and I are into our second week at the Jersey Shore. The weather's been great, except for Monday, and the markets have continued on. Volatility is something we're going to talk about, and how you can use options to profit from volatility. For those of you who haven't been on a webinar before, a little bit of my background: 50 years on Wall Street. 45 years I've been using technical analysis, but always in conjunction with fundamentals. I headed the options department at a major brokerage firm for 5 years, so when we talk about options, I've got a lot of experience under my belt. And along the way, I've been mentored by some of the smartest and most successful institutional investors. Some of them were clients at an institutional brokerage firm that we sold to Reuters in 1992, and some of them were colleagues. And being mentored is really important. That's why I love doing these webinars. This is my way of giving back, of mentoring people, showing them an approach to the market that is working and has worked for so many of our members. When I came out of retirement in 2009, after the financial collapse of 2008, my mission was to create something that went way beyond technical analysis. Many of you know the Chaikin money flow, which has been around since 1982, technical indicator that measures supply and demand, as we'll see. But I wanted to do something new and different, and it's really the culmination of my life's work. I took everything that I learned from those smart institutional investors, successful hedge fund managers, value managers, growth managers, distilled it all down into the Chaikin Power Gauge rating, and that's the centerpiece of what we're going to be talking about today. And as you'll see, it's your directional edge if you're an options trader. So in this afternoon's webinar, we're going to cover 5 key steps to successful options trading. Finding the right stocks to trade from the long and the short side, using that combination of fundamentals and technicals. A very unique way to use Chaikin money flow to anticipate future price movement that you won't read about in any of the documentation on your online brokerage platforms. How to use rules based exits and entries to help better time your options trading. And then we're going to look at a very specific pattern of spikes after earnings reports and show you how to distinguish between the stocks where you need to sell the spike and the ones where you can hold on. Really interesting stuff that we haven't talked about on any webinars before. I'm going to show you how to play good defense, which very often means turning lemons into lemonade, taking losing stocks and turning them into good, profitable put trades. And then finally, using our options play embedded module, how to find high probability based options trades. So I'd like to start the webinar off with a poll question. Josh, if you had a chance to get that teed up. Do you see risks ahead for stocks? And a simple yes or no answer.
If you could just put the answer in the Zoom Q&A window.
Yep. Josh, tell me what you're seeing.
Starting to roll in, Marc. Mostly yeses. So we got a lot of yeses
So
rolling.
You are seeing risks. Well, that's interesting. We did a webinar, Sandy and I did a webinar last week, and most people were pretty sanguine about stocks. So every is different. And because of that, I'd like to review the market before we get into the specifics of what Chaikin Analytics can do to help you make money in volatile movements during earnings season and beyond. What we've basically experienced for the last 18 months is a market that was in an uptrend on autopilot in 2017 with almost no pullbacks, to a roller coaster of a correction in 2018 18. And that's the volatility that everybody's been talking about. But the reality is volatility has come back to normal in terms of the overall market, but not for individual stocks. And that's what we're going to be zeroing in on today. You can take advantage of volatility in individual stocks, serious profitable options trades. So here we're looking at a one-year chart of the SPY. It's the most actively traded instrument in the US markets. It's the ETF that mirrors the S&P 500 large cap index. So we've got a one-year chart. And the key takeaways from this chart is that we formed a W-shaped bottom in February and March. And the reason that's important is because after a year in 2017 where we didn't have a pullback of 3%, we got better than a 10% pullback in February of 2018. And pullbacks of 10% or more in the S&P on a closing basis almost always end in the shape of the letter W. The first selling is typically panic selling. There's your high volatility down wave, accelerated by a blow up of a very esoteric exchange traded note. You rally up, then you come back down and test the lows. Sometimes you break the lows. When you're in an ongoing bull market, typically you see just what we're looking at here. Tested that low of 2533 on the S&P 500. That's a key number. Please remember that number, 2533, 253 on the slider. Since that bottom in March, we've maintained a really nice uptrend, but the S&P kept running into resistance at 2800. Now we look at Chaikin money flow. We see the trend. We see that we actually broke. Cap stocks actually broke out here in May, and they've been outperforming until just the last 3 weeks when the large cap stocks have caught up. But Chaikin money flow is our way to measure whether the institutions are behind the move or fading the move. And if we look back into the fall and winter of 2017, we see that there was big institutional buying all the way up into the peak of 2873 on January 26th. And in the first phase of that W, institutions were actually getting liquid and selling the spider. But now there's been intense accumulation. We've gotten overbought yet again on our short-term oscillator, but Chaikin money flow is strong. So this chart encourages me that we're still in an uptrend. However, what's the real scenario for 18? Well, it's on the right, higher interest rates and rising earnings. Now, you're going to hear on CNBC and read in the headlines that rising interest rates are bearish for the market. Jamie Dimon, the CEO of JP Morgan, actually said interest rates might go to 5%. Didn't even phase the market because people are starting to realize that rising interest rates in a period of rising earnings are actually bullish because they reflect increased loan demand and the strength of the economy, as long as the economy doesn't overheat. And there's a lot of things happening that suggest the economy won't overheat, even though we had 4.1% GDP growth in the second quarter. If interest rates were to get to 5%, Jamie Dimon's prediction, that would be of concern. But with interest rates here around the 3% level on the 10-year Treasury, we're in a very bullish scenario, and we'd like to find out how to take advantage of that. But that short-term trend of the market, seasonality, is now what we have to deal with as we've ended earnings season. Second quarter earnings season ends this week. We're now in this lull between middle of August and Labor Day, and particularly in midterm election years, this is a period when the market typically experiences a bit of a pullback. So this is actually a story from Barron's in March of this year. Expect stocks to drop before midterms. And they say from the midterm low, that's the low of 2018, to the pre-election year high, that's 2019, the Dow, believe it or not, has averaged a 50% gain since 1914. Now in 2014, the Dow rallied 20%. But let's look at the numbers that we just covered on the chart. Let's assume that the low that we saw in February or March, 2533, is the low. Maybe we get a pullback of 4 to 8% here between now and October. It's a period when the market typically sells off August and September and into October. If 2533 is the low and all we did was rally 20%, that would take you up above 3,000 on the S&P 500. We're currently trading in the low 2800s. If we got that 50% move, wow, everybody would be totally shocked because 50% from 2583 is about 3,800. So somewhere between 3,000 and 3,800, based on the probabilities and the actual trading of the market over the last 100 years, is what we can expect. But how do we get from here to there? The answer is we're probably going to get a pullback in the market. So if you're seeing risks ahead, please limit your thinking to short-term risks, not longer-term risks. The bull market is still intact. It's an earnings-driven bull market. Second quarter earnings came in better than expected. Revenues beat estimates. Corporate guidance is still positive. And we've lived through all these side influences, the tariff rhetoric, the weakness of the Turkish lira, all sorts of geopolitical headlines and tweets, and yet the market is still standing, and it's the best market in the world right now. World markets are down in 2018. U.S. markets are up about 4%. So a very bullish backdrop. But if you want to profit from a pullback from this August peak, here's one way to do it. And we're going to explain why we like vertical put and call spreads in a few slides, but the bottom line is, if you think the market could drop 3.5% between now and September 28th, you can buy a 284 put and sell a 273 put against it. It's called a vertical bearish put spread. It enables you to earn almost a 300% return on the 3.5% drop in the S&P, and your risk is limited to the cost of the put, $279. It's a lot better than buying that put outright, because that would cost you $475, and your return potential would only be 128%. This is probability-based options trading, but vertical put and call spreads almost always give you a better bet. And in our options play module, it's been circled by options play in green with a check mark, meaning high probability that this will be a profitable trade. If the market drops, profit potential 288%. You could also protect a portfolio. Let's say you've got 283,000 in your 401k plan. Buy 10 of these spreads, $2,800, protect yourself against a 4% drop in the market, stay fully invested. And then when the uptrend resumes and that big rally potential of somewhere between 20 and 50% to the high in 2019 surfaces, you're there. If you're an options trader, you want to be looking for buying opportunities. Now we're going to show you how to find them. One of the problems we all face is information overload. We're all familiar with our crowded inbox, email, Snapchat, Facebook, LinkedIn, Twitter. It's just too much. And in the investment area, there's all sorts of noise on CNBC and Fox Business. And I particularly like Jim Cramer. He's a partner of ours, but there's lots of information to process. So we created Chaikin Analytics as the solution to information overload. We're going to show you specific examples of how that works, including, as Josh said, a live run-through of how you find profitable options ideas quickly and easily in Chaikin Analytics. Now, everything we're talking about on this webinar is summed up in this one slide. Fundamentals drive the market, but emotions drive the market to extremes. That's why, for me, for 45 years, the path to profits in the stock and options market has been a combination of fundamentals and technicals. One without the other is an incomplete picture. If you combine them, you've got the best, and you need the right tools to do that. Now, because we've done such a good job of combining fundamentals with technicals, a lot of very successful and highly visible traders and market participants like John Najarian, like Jim Cramer, like the people at Fidelity and Soros Hedge Fund have embraced Chaikin Analytics again. Power Profits, Tom Gentile's options trading site. And in fact, a week from tomorrow, the 22nd of August, I'm going to be doing a 1-hour private webcast with Jim Cramer. You can go to the street.com website and sign up. We had 5,000 people on our last webinar on the 29th of January. Very informative. We're going to be talking about the stocks to own for the booming economy. 4.1% growth in GDP. I'm bullish. Jim's bullish. We're going to have some really interesting ideas. Now, the Chaikin Power Gauge gives you an edge. When I ran an options department for Tucker Anthony, regional brokerage firm, 25 offices, over 250 brokers, and tens of thousands of options trading clients, 95% of those clients lost money. And those numbers would probably still be true today. The reason was they didn't understand the importance of a directional edge. Back then, the directional edge that I tried to provide was technical in nature, technical analysis, oscillators, money flow. Now your edge, the directional edge, is through a combination of fundamentals and technicals that we've combined into the power gauge rating, a quantitative model that's proven itself over the last 7 years. And then we provide buy and sell signals for better entries and exits. So what is the Chaikin Power Gauge? Well, it's a very simple display meant to look like the gas gauge on your car. It goes from very bearish to very bullish. But under the surface, there's some real number crunching going on. So what I like to say on these webinars is that the Chaikin Power Gauge rating is like a Chevrolet with a Ferrari engine under the hood. And it can be your GPS during earnings season. This is where you can take advantage of volatility using options which have limited risk to make outsized gains. And our members have been doing this regularly for the last 6 years. So John Carter, who's a partner of ours, discovered the Chaikin Power Gauge rating about 3 years ago. And at the time he said, this looks like an objective awesome meter for stocks that combines 20 plus technical and fundamental factors to anticipate a stock's profit potential. It's called the Chaikin Power Gauge, and at first glance I thought it looked like an objective awesome meter for stocks. Coming from John Carter, who's one of the best pure traders I've ever met, this is high praise indeed. But let's look at what John Carter got so excited about. The factors in the Chaikin Power Gauge rating address 4 primary components: value, growth, technicals, and sentiment. And within each of those 4 primary factors, there are 5 sub-factors. When you take them all together, this is what I learned from 30 years of working with successful institutional portfolio managers. They all had different styles and different time horizons, but they stuck to a discipline. So the value investors looked at those value metrics like price to sales and free cash flow to market cap. That's what Warren Buffett looks at to this day. And Rob Arnott, who ended up managing 180 billion, and just 4 factors drive that performance. Growth investors like Jim Cramer, like the big growth funds at T. Rowe Price and Fidelity, looking at the earnings factors. Technicals are only 15% of the model. This is a fundamentally driven quantitative model. And sentiment is our secret sauce. Short interest, insider activity, industry group relative strength, not normally seen in quantitative models. So this is a special model. It works because it's based on how Wall Street works. It's not a model built by some newly minted PhD at MIT, throwing what I call digital spaghetti on the wall. That's what got us in trouble in 2008. And in 1998, when a couple of Nobel Prize winners almost blew up the markets at a firm called Long-Term Capital Management, because they built some quantitative models that didn't take into account the extremes that emotions take Wall Street to. So I boxed 2 factors here: earnings surprise, because we've just ended earnings season, but there's another one coming in October. And my colleague George Douglas at Drexel Burnham, who had built a quantitative database, did the original research in earnings surprise, companies that either beat or miss analyst estimates. And what he taught me was that earnings surprises come in bunches. There's never just one of them. So we built that into the model, but more importantly, earnings surprises lead analysts to raise or lower their estimates. We'll see an example of that in a minute. And that's important because research has shown that analyst estimate revisions are the biggest short-term driver of stock price movements. And then finally, industry group relative strength, putting the wind at your back because these are big macro trends. So the model picks up on longer-term value factors, shorter-term but persistent factors like earnings surprise, earnings estimate revisions. And the proof is in the pudding. The model was locked down, frozen in 2010 in September, never changed. The weights haven't changed. Value is 35%, free cash flow and price to sales, the two biggest components. So there's a value bent. But the model is eclectic. It finds a lot of different ways to like or not like a stock. And we're going to show you how to incorporate the fundamental heavy lifting that the Chaikin Power Gauge does into your decision-making process. Now, performance is everything, and this is the performance of the Power Gauge using the Russell 3000 index as the core universe. The average very bullish stock going back to 1999, up 20%. Now, some of this is back-tested results, which always look good, but starting in December of 2010, it's real-time performance. And it's been mirroring the back-tested performance. Very bearish stocks down 1%, even after a 9-year bull market. If we were looking at this chart in 2010 or 11, the very bearish stocks would have been down 5% over the previous 10 years. Very important to differentiate between bullish stocks to trade from the long side, bearish stocks to get out of your 401k plan and trade using vertical put spreads. Now, in 2015, it was really important to know which stocks had bearish ratings, bearish fundamental potential. Power Gauge does the heavy lifting on 5,000 stocks updated nightly. Small cap stocks were in their own bear market in 2015. The energy stocks, the fracking stocks, Range Resources, Kinder Morgan, Pioneer, you know the names. They were in their own bear market. You had to avoid them. Kinder Morgan went from 42 to 12. Under Armour went from 44 to 10. If you stayed in these stocks, you didn't sleep at night. If you were following the Power Gauge, you get out of them. Will you miss an occasional winner? Of course you will. But it's like a sleeping pill for investors and traders. You sleep better at night knowing that you can differentiate between a winning and a losing stock. Now, the final validation of the Chaikin Power Gauge that I want to share with you is that on April 1st, we had the honor of ringing the opening bell on NASDAQ, along with our partner Index IQ, a subsidiary of the largest mutual insurance company in America, New York Life, to celebrate the launch of 2 exchange-traded funds, Chaikin Small Cap Fund, Chaikin Large Cap Fund. This is not a recommendation to buy those ETFs, just more validation that the Power Gauge works in a rules-based buy and hold environment. And we were excited to see the Chaikin Power Gauge up on the tower, the NASDAQ tower in Times Square. So very exciting validation for the 26 people who work at Chaikin Analytics in Philadelphia who've worked so hard in the last 3 or 4 years to bring these products to market and to help support our members on a daily basis. Now let's get into the meat of how you use the Power Gauge to find winning trades. We have a pattern that we want to share called Classic Chaikin Bulls. Just 3 components. Think of how difficult some approaches are. This is so simple and it's very visual, as you'll see. Power Gauge rating is bullish, meaning the fundamental potential is strong. The stock is outperforming the market. We'll explain in a minute why that's so important. And Chaikin money flow is strong, telling you that institutional investors are accumulating the stock. So here's our poster child, and has been actually for almost a year, for the Classic Chaikin Bull. The interesting thing is when we sort of hook into a stock for Classic Bull or Classic Bear, there's a persistency and they tend to stay that way for a long time. So we actually read the chart from the bottom up. Why? Because your directional edge, the Chaikin Power Gauge, is a red, green, yellow ribbon at the bottom of the screen. Primarily bullish in this wonderful Medicare stock who's figured out how to navigate shark-filled Medicaid waters and make money even when the government is cutting back. They just made a big acquisition and took on 2.5 million additional Medicaid accounts from the Midwest. Then we look to see if the stock is outperforming the market, because we want the market to agree with our fundamental quantitative model. No matter how good your fundamental research is, if the market doesn't agree with you, guess who wins? The market always wins. My good friend Marty Zweig, who died sadly way too young, used to say, watch the Fed and listen to the market. Don't fight the tape. So what we found is that the biggest gains come in stocks that have bullish fundamentals, power gauge is green, that are outperforming the market. Again, we've converted relative strength into a red-green heat map. Very easy to interpret. Obviously, Centene has been outperforming the market. And then we look at Chaikin money flow, and we see that Chaikin money flow has been bullish. It was bullish back in the fall and winter of 17, and institutions are buying the stock yet again. So everything is in place. And now on the upper left, I'm showing you a new feature of Chaikin Analytics that's really critical to trading. A lot of trading coaches suggest keeping a journal, and that is a good thing. We make it even easier. You can put a note up on any stock and jot down your thinking at any given point in time, particularly when you make it buy or sell or not sell. So on this chart, there was a buy signal in Chaikin Analytics. This is our relative strength buy, and I'll explain this a little later. And then right here before earnings, I had made a sell spike ahead of earnings, and the stock spiked up to a new high. And we're going to get into this pattern because it's really helpful to know which earnings spikes you should sell and when you should sell ahead of an earnings report. So everything you need to know about a stock is on this screen. We color code the earnings red, green, or gray, telling you whether the company has beat estimates. We show you when the next earnings report is, give you access to the options play ideas module, and then we show you whether stocks are seeing their estimates raised by Wall Street analysts. And again, strong trend, strong industry group. This stock has everything going for it, and it made a new high today. Now, it's nice to know there's a pattern that works, but how do you find them? So in this case, for a webinar I did on July 18th, I screened for large cap growth stocks. I mentioned that small caps had been underperforming the market. I felt large caps were overdue. So I screened for large cap growth stocks. That's a universe we create automatically, 529 names. Power gauge had to be bullish. I wanted companies with strong free cash flow. I wanted solid companies. And then the other two components of the classic bull, Chaikin money flow and relative strength, I narrowed a list of 529 names down to 12. I'm going to show you a little later in the webinar in a live demo how you can do that as well. On that list was Centene, that we've already looked at as a classic bull, WellCare, that we're going to look in a minute, and Expedia. So some really interesting names. Most of them have had really solid moves. Humana's had a very big move recently. Biogen, very volatile, as we'll see. You can screen for them. The unique feature here is custom universes and the ability to screen on a quantitative model and any of the 20 factors within the model. So if you think sentiment is important, you can just screen on sentiment and say, I want sentiment to be bullish. I want the experts on Wall Street, short sellers, insiders, analysts to be bullish on the stock. I want to be in good company. Now let's look at a chart of WellCare, which was on that list. And WellCare had given a buy signal about 2 weeks ago. We call this our oversold buy. That's a new 8-day low in a stock with a bullish power gauge. So we're always looking for an edge. We're screening for bullish power gauge or relative strength, and then looking for a what happened here was the stock was down a bit ahead of earnings, positive earnings surprise. It spiked up. And when a company's not at its high ahead of an earnings report, it's been safe over the last year or two to just stay with it. And if they surprise to the upside, ride that. So big move in WellCare, also in medical care. Now classic Chaikin Bear, turn everything on its head. Power gauge is bearish. That means fundamentals are not good. Stock is underperforming the market, and Chaikin money flow is red, not green, telling us that the institutions are persistent sellers of the stock. So here's Tesoro Inc., a biotech and drug stock, and we've used this, believe it or not, since December as our classic Chaikin bear. Again, reading the chart from the bottom up, power gauge bearish, fundamentals are not good. Underperforming the market, relative strength is weak, so the market agrees with the model, but on the downside. We call that the dynamic duo. Institutions selling the stock. If they're selling it, you want to be selling it too, and you certainly don't want to own it. And then these relative strength sell signals. So what is a relative strength signal? A stock that's been underperforming the market, and we know that because our indicator is red, rises above its 21-day average and then the 21-day average. That constitutes a relative strength sell signal. If the power gauge is bearish, it's even more powerful. These signals typically work 70% of the time, and the beauty of them for options and swing trading is that they last 4 to 8 weeks. Now think about that. You don't have to worry about time decay. You can buy an in-the-money option, an out-of-the-money option, 20 delta, 80 delta. If you're familiar with options, you know what I mean. And really benefit from big moves. And even recently, with another negative earnings surprise just 7 days ago, the stock made another new low. This stock's gone from 125 to 27 in a bull market. Think about that. So do you all understand the value of reading the chart from the bottom up? If you do, type a big V into the chat window, and Josh, tell me if we're seeing a lot of V's on that. Before you even look at price, see what the fundamental potential is, see if it's outperforming and what the institutions are doing. Then look at price.
Lots of V's rolling in, Mark.
That's great. So we're going to continue on at a fast pace. Everything we've talked about is encapsulated in this triangle. Successful trading in volatile markets and non-volatile markets demands a disciplined methodology. Anybody who's read Jack Schwager's Market Wizards books knows that everybody he's profiled and interviewed has been successful because they followed a disciplined methodology. Whether it was Peter Lynch at Fidelity or a hedge fund gunslinger, they all have their own discipline. We've tried to model those in the 20 factors in the power gauge. So top of the pyramid, power gauge rating and industry group strength. Bottom of the pyramid, just those two technical indicators, Chaikin money flow and Chaikin relative strength. And the sweet spot for options traders is right in the middle, Chaikin buy and sell signals. Now, I know that there's a high level of options knowledge on this webinar audience, but for those of you who are relatively new to options trading, and even for the experienced traders, let me just recap some very simple truths. The simplest way to use options is to buy a call option if you're bullish, betting that the stock's going to go up, knowing what your risk is, that's the cost of the trade, or buy a put option if you think the stock's going down. Again, fixed risk, the cost of the option. But there's one big problem, and it's known as premium erosion. An option is a wasting asset. It has a finite life. It expires. And if the option is not in the money, meaning that it has value when it expires, it's worthless. And too many options traders, those 95% of Tucker Anthony who lost money, bought short-dated options out of the money. They were stacking the odds against them. Because as you get closer and closer to expiration, premium erosion is deadly. It's like rot at a beach house. So what's our answer to vertical spreads? High degree of probability versus buying puts or calls outright. So bullish or bearish vertical spreads, you can do them in any account, and they really do pay off. You're not looking for the big home runs, the 3 and 4 and 500% gains, but you will consistently do better with vertical spreads. And here's an example of that. Google is a stock, one of the FANG stocks that's had a bullish rating. Amazon recently has, as well as Apple. And back in June, it gave an overbought sell. I'm sorry, an oversold buy. New 8-day low in a stock with a bullish power gauge rating. Great buying opportunity. Stock had pulled back from 1,200 to 1,100. Subsequently moved up to 1,250. You could have bought a vertical spread for about $2,900 because premiums were low back then. That spread widened out from 29 to 100. Almost a 250% gain on a 10% move in the stock. Here's what a spread looks like right now, a vertical bullish call spread on Google. Don't think it's a great time to put it on because the stock is sort of midstream, looks double toppy. Seasonality, as we said in the market, is not good. But if you wanted to bet on Google that it was going to go from 1246 to 1325, instead of buying the put option, the call option rather, for $3,600, you do the vertical call spread. It only has a 101 rating. Not high enough, although it gets a green circle and a check mark. Only 180% return. Seasonality is not favorable. In my view, not a good time to be doing this. Only marginally shows up in the green column. Now, for a webinar we did with Tom Gentile on July 26th, we knew that Expedia was reporting after the close. And it had a bullish rating, outperforming the market, good Chaikin money flow. It had just triggered a buy signal, and it had sold off a little bit before the earnings report, which typically is something I like. So I went into options play before the webinar, and I brought up the screen, automatically gave me three choices: buy the stock, buy a call, or put on the vertical call spread. But look at the probabilities, 59 circled in red. Cost of that trade, $775. Because Expedia had been volatile, the options were expensive. And the return, if it went from 126 to 141, a little more than a 11% gain, was only 93%. So let's see how the price action in Expedia followed the earnings report. Well, these were bad odds, so on that webinar, I said I wouldn't take this trade, even though I like the stock. Now, Expedia reported better than expected earnings. It spiked up from 127 to 138, but immediately started to pull back. You had to sell that spike. And even now, with the stock 4 points higher, that spread is underwater. So that probability helped you screen out an unprofitable trade in a strong stock. It's the trades you don't take that make the difference at the end of the year. Anybody can put on a trade and pull the trigger, but pulling the trigger on the high probability trades is how you make money. Now, I want to show you a pattern that we call personality changes. We define a personality change as a stock that was outperforming the market that begins to underperform, or vice versa, a stock that was underperforming the market that begins to outperform. And our poster child is Macy's. Back in December, everybody was talking about the death of retail. Amazon was going to take over the world and bricks and mortar retailers were toast. But something happened. There was a positive earnings surprise on Macy's, and you had, in reaction to that up move out of a base, what we call a bullish personality change. Our relative strength indicator went from red to green, and then the power gauge turned bullish. So the question is, do we want to buy a breakout? And the answer is no. Buying breakouts works about 20% of the time. We like to wait for the first buy signal after the personality change and the breakout. And that was your oversold buy signal back there in late December at a price of 24. A series of them. These signals work about 66% of the time, and they're meant for shorter term traders, 5 to 10 trading sessions. So the strength signals 4 to 8 weeks. So you can see on the chart, 3 out of 4 worked, and the most recent one is working, and the company reports earnings before the opening tomorrow. If we were talking with the market still opening, I'd say you probably should sell Macy's ahead of the earnings. Why? Because it made a new high today, up 1.5%. It's at its peak going into the earnings. Basically, things can only go wrong. Very similar to what happened back here in February. Sell the spike. Turned out to be a very good thing. On the other hand, here, when the stock was down into earnings, you didn't have to be so quick to sell because people were leaning negatively. Here, they're leaning positively. Now let's look at a bearish personality change. Albemarle Corp, it's in the S&P 500, not a well-known stock, but a very big chemical stock. Bearish personality change in December with the power gauge already bullish. The institution started selling it. Do we want to sell that initial breakdown? No, we wait for the first sell signal back here in January. Price was 130, ultimate low was 88. And then you got a second chance. It gapped down and it rallied up magically ahead of that earnings report. Wall Street is ever hopeful, but everything was against it. Power gauge bearish, underperforming institution selling. So you sell along with them. You put on a vertical put spread. The stock dropped from 115 all the way to 90. And even after it finally reported a positive earnings surprise here and here just a week ago, the stock is still struggling. Not yet ready to be bought because it's still underperforming the market. Now, in 2016, SunEdison illustrated why it's really important to know about personality changes. This stock was being recommended by big brokerage firms. Major hedge fund David Einhorn owned a huge position, as we'll see in a second. But somebody knew something. The power gauge was bearish in July with the stock at 26. Bearish personality change. Look at the institutions. Do you think they were fooled by what was going on? Other than David Einhorn, the answer is no. And plenty of opportunities to sell the stock along the way, put on put positions. This chart ends in because the company filed for bankruptcy. Now, 2 weeks ago on CNBC, David Einhorn had this to say. Yes, we've made some obvious mistakes, the worst of which was not assessing that SunEdison was a fraud 2015. Well, if you were following Chaikin Analytics and this three-part discipline that's so simple to implement, you would have been smarter than one of the most successful hedge fund managers of the last 25 years. He's had a 3-year period of poor results, but you don't have to be a hedge fund manager or know how to spot fraud. Just follow the tracks of the power gauge rating, money flow, and relative strength. This is perhaps the most powerful slide I've ever put together. David Einhorn gave us a gift when he went on CNBC and acknowledged that this was one of his big mistakes. Now, I want to show you one last pattern that you won't see in any textbooks, in any documentation, stockcharts.com, your online brokerage firm, Reuters, Bloomberg. We call it the secret sell signal that most traders never see. It's called a bearish Chaikin money flow sell alert. And let me go slowly here because this is so powerful. If you're using stockcharts.com, you can find it, or Thinkorswim, or any of your online brokerage platforms that have Chaikin money flow. So what is a bearish money flow sell alert? Well, we're looking at a chart of Advanced Auto Parts that ends in May of 17. Advanced Auto Parts had a big momentum move up. The fundamentals were negative, but they had a positive earnings surprise. They caught the shorts leaning the wrong way. Now, does everybody know what that means? Leaning the wrong way means heavy short position into an earnings report, what they call a crowded trade. Think of a rowboat, Washington crossing the Delaware. Too many people in the rowboat. You hit a big current and rowboat's likely to turn over. Or if you're a sailor, you know what happens when the wind shifts. So the stock had a big up move. A lot of that was short covering. And money flow should have turned positive, and it went barely positive on the first part of the move here in December of 2016. But then when it pulled back, came up to equal its previous peak, look at Chaikin money flow. Red, not green. Institutions, smart money, were selling the stock under cover of strength, and that triggered what we call a bear. It's one of the only ways I know to sell a stock at a new high with confidence that you're not going to leave too much money on the table. Now, some people go short on that signal. You've got to have a close stop or buy the put spread and know what your risk is. Then we had the standard Chaikin progression. We had the power gauge turn bearish, bearish personality change, institutional selling. So we're looking for opportunities to sell right ahead of this May earnings report. With the stock at 150, we got an overbought sell signal, new 8-day high, negative earnings surprise, the stock gap down, traded all the way down to 130. The ultimate low on the stock, 78.87. You could have been selling it at 175. You could have been selling it on the bearish personality change here at 150. The sell signal at 150. Multiple ways to get out of the stock if you were long. And by the way, all the auto parts stocks were down in that period. And put on a bearish put spread. Now, here's a more recent example. Mohawk Carpet Company suffering because the housing stocks are not doing well. Power gauge is bearish. Institutions are selling. And we got our first bearish money flow sell alert back in January. Stock equaled its old high and money flow stayed red. It should have gone green. Institutions were selling. Smart money was getting out. That triggered a bearish money flow sell alert. And then just recently, back in April, excuse me, another bearish money flow sell alert. This time, the stock got overbought and money flow stayed negative ahead of a negative earnings surprise. So the stock dropped from about 235 all the way down to 210. And guess what? The pattern repeats again at the next earnings report. Sell signal comes a little early. But boy, did that work out from 220 all the way down to 180. And since we're in volatile markets, you want to cover your short position, close out, take your profit and your puts. It's a choppy market. So everything we've been talking about, we call the ideal setup. Chaikin power gauge, relative strength, and money flow. Warren Buffett calls it the fat pitch. He has famously said they don't call balls and strikes on Wall Street, so you don't have to swing at every pitch. Don't overtrade. You can wait for your pitch. He calls it the fat pitch. We call it the ideal setup. The missing piece, buy and sell signals. We have 6 pairs of buy and sell signals in Chaikin. You can go to our website, whether you're a guest or a member, and see the basis for these signals. And they've worked, as you've seen. So we have 2 ways for you to know when a signal is triggered. We encourage everybody who's a member of Chaikin Analytics to keep a list they call My Stocks. And then we have all the market averages, ETFs, industry groups as lists. So you can see on any given day which stocks in a list has triggered a buy signal or a sell signal or an alert. In this case, for a webinar I did on April 5th, Adobe had given a relative strength buy signal at 225. At that yellow arrow, you could have bought the stock. It was in an uptrend, had all, so nothing lines up all the time. But if you buy using a disciplined approach that's based on proven analytics, it's a heck of a lot better than trading on your emotions. And you can see that all 5 of the relative strengths buy signals in Adobe have worked, and the durations are 4 to 8 weeks. Powerful signals for options traders. Now, we introduced something in May based on subscriber and member feedback, daily email alerts. Some people can't or don't want to go into Chaikin Analytics on their desktop or the iPad every day, so we send you an email at 8 in the morning telling you what stocks have triggered buy or sell signals or had rating changes or estimate revisions. So here's my screen for a webinar I did on June 26th. Citrix, out of the 40 stocks I follow, was the only one that triggered a signal, oversold buy at 104. And also note that Chipotle turned bullish and Expedia, which we saw before, had a positive earnings surprise. A month before was showing analysts raising their estimates into that earnings report in late July. So this is what Citrix looked like. There's the signal, 104.46. spiked up all the way to about 114. And because we're in a volatile earnings climate, we recommended selling the spike. And then the stocks pulled back, but that's another move. Here's what my email alert looked like today. Again, 40 stocks. There's that oversold buy signal in Expedia. And interestingly, a stock called Mosaic, which is in the agribusiness, showed that analysts were raising their estimates up 10%. Well, that's something that makes sense based on the factors in the model that we described, because you had a buy signal here in early July with the stock at 27.70. You had a positive earnings surprise and the stock spiked up. And again, we want to sell the spike. And now analysts are raising their estimates. So the downside is going to be very modest on this stock, in my opinion. And we're looking for an oversold buy signal, a new 8-day low with the power gauge bullish, to get back and position ourselves for another long trade, either buy the stock or buy the vertical call spread. Now, I said early on that good defense can help you turn lemons into lemonade, because it does lead to good offense. We're blessed in Philadelphia that the Eagles won the Super Bowl. It really, except for that trick play, was based on the defense that stopped the Patriots. So let's look at some examples of playing good defense. Good defense means avoiding stocks like Philip Morris, where everything is bearish. It's a classic Chaikin bear. But then it also means looking for a signal to buy a put option or a vertical put spread. This one came right ahead of earnings. And look what happened. The stock dropped from 101 all the way down to 83. And then you take your profits. And it actually happened again. It's hard to see on the chart because there was so much downside. At the last earnings report, we had an overbought sell. Stock was about 83.50. Negative earnings surprise, gap down to the lower volatility band at about 78. Take your profit on the put trade. Wynn Resorts, a very recent example. Bearish personality change. You play good defense. When you see that bearish personality change, you're out of the stock. Power gauge has been bearish, so when it breaks our long-term trend line at about 185, you want to be out. And then you're looking for an opportunity to buy a put or a put spread. That came, again, right ahead of earnings with the stock at about 160. Negative earnings surprise, spike down to 148, close 146 in this case, close out the trade. But this stock's not going anywhere because everything is negative. And these relative strength sell signals persist, as we said, over 4 to 8 weeks. Notice how the relative strength buy signal worked on the upside here in January, 160 to 200. Then again in April, 180 to 198. Relative strength signals are really powerful. Now let's have a little fun as we wind down the webinar and go to the live portion. I was quoted on a Jim Cramer event that we did on January 29th as saying that bottom fishing is the most expensive sport in America. I used to be guilty of that. I don't do it anymore. So what I've done here is, at the bottom of the screen are the primary technical indicators we've been talking about on a very well-known stock. Power gauge is bearish, underperforming the market, but Chaikin money flow was starting to firm up, and a lot of people were saying maybe it's time to bottom fish in Whirlpool. Well, look what happened. Whirlpool, which had recently made new 52-week lows in May at 140, gave an overbought sell signal in July about 5 days ahead of earnings. Negative earnings surprise, gap down. Stock dropped from 150 all the way down to 125. Trading at 124.40 today. Bottom fishing just doesn't pay. Nobody knows where the lows are. The housing stocks, we saw Mohawk Carpets, Whirlpool Appliances. They're keying off softening housing numbers. There are big macro trends. The industry is weak. Don't fight the trend. Don't bottom fish. That's part of playing good defense. Now let's talk about profitable options trading in volatile markets. Volatility engenders fear, that equals opportunity. So you follow the power gauge ratings in that pyramid discipline. You use options plays to find high probability ideas and then rules-based entries to get into the trade. So here's an example of that. HCA used to be Hospital Corporation of America. Buy signal in June, again, another medical care stock. The group is very strong. Previously, they had a positive earnings surprise. Notice how the stock was making new highs the day before the earnings surprise. In those situations, you want to sell the spike or sell ahead of the earnings report. Back here in April, it was way under its high with a positive earnings surprise and it crept up. Here you had a bullish signal, relative strength signal, followed by a positive earnings surprise, but the stock was not spiking up. So you can wait a little and then sell into the strength. But when you're an options trader, these are gifts from the gods. You've positioned yourself right, you pulled the trigger at the right time for all the right reasons, take your profits. Here's Biogen, another very spiky stock. Leader in the biotech industry. We had a overbought sell signal, oversold buy down at 282. The stock spiked up for a fundamental reason. They got a favorable FDA review on an Alzheimer's drug, second stage. Then it pulled back again, positive earnings surprise. It spiked up, sell the spikes, because right after that, the same news that drove the stock up drove it back down again. Same results, same Alzheimer's tests. The markets can be very volatile in terms of individual stocks, even when the overall market is quiet. It pays to sell the spikes in the current market environment. So one final look at earnings season. How do we know which stocks to focus on? How do we know to focus on Biogen or Mohawk, MHK, or HCA on the upside? Because every week in my weekly Market Insights newsletter, we highlight the stocks that are due to report earnings in the coming week. There's Expedia on July 26th, that chart that we showed you. And we tell you whether the power gauge is bullish or bearish. So we give you a heads up every week as to which stocks to be looking for. Centene's in that list. So here's an example. Chipotle, very spiky stock, big positive earnings surprise back here in April. The power gauge turned bullish, positive bullish personality change. Stock just kept going. And then you had a pullback and you got a buy signal, relative strength buy signal at about 440. Took about 2 weeks to work out, but it spiked up to 470 on a positive earnings surprise. Then there was a little bit of concern about health issues in one of their restaurants, and the stock pulled back to the 420, 425 level. Buy signal, buy it again. The key is sell the spikes so you take your profits and you're prepared to enter the stock again if you get a signal. Amazon, very expensive stock. This time it spiked up on earnings and came back and then triggered an oversold buy signal. So you can see you can make money before earnings, during earnings, and then in this case on that nice pullback to the 1750 area. It's rallied up to 1900. A perfect candidate for a bullish vertical call spread. You're not going to spend $190,000 to own 100 shares of Amazon. You could buy an odd lot, or you could buy a vertical put spread for a fraction of that cost, know what your risk is, and then sell the spike when it comes. Facebook, totally different story. Facebook was making new highs into the earnings report. Our advice on a webinar that we did the day those earnings were due out was you should be out of Facebook ahead of the earnings report. Why? Because it was already making a new high. And guess what? The insiders are selling the stock like crazy. Mark Zuckerberg is selling the stock in millions of share multiples. If he doesn't believe in the stock, why should we believe in it? So the stock gapped down and it's trying to rebuild, but it's going to have a hard time getting through that 190 level. So it looks a lot different than Google or Amazon, even though it's part of the FANG stocks. But if you're a long-term believer in Facebook, which pays no dividend, you could write a call option, a covered call. In this case, Options Play was suggesting that you, with the stock at 180, you write a Facebook 190 covered call, expires on September 28th, so about 5 weeks to go. That's a 1.4% return, 10 points out of the money in a stock that pays no dividend. That's an 11% annualized return. The stock's probably going to run into resistance at 190. Odds are, with weak seasonality, Facebook is under 190. The option expires worthless, and you've pocketed some nice change for your efforts. Now I'd like to go to the live part of the demo to show you how easy it is to find winning trades. So this is the Chaikin Analytics desktop. Josh, can we see that?
Mark, I'm not getting your desktop.
Are you seeing it now? I'm going to do a new share. How's that?
Do the share screen, and hey, there you go.
Okay, so this is where I normally hang out on Chaikin Analytics. This is a My Stocks list with 35 symbols in it. I like to see what happened today, so I click on our panel view, and I see that 32 of the 35 stocks were up. They're ranked by percentage change, so Macy's was up 4.5%. We already saw a chart of Macy's heading into tomorrow's earnings report. Probably means there's going to be selling after the stock opens tomorrow. So that's my basic view. But let's say I want to find new ideas. There's Mosaic that we talked about. A lot of stocks that we talked about are in this hedge fund portfolio that we created. Centene, Expedia. We follow the discipline. Biogen. We sort of eat our own cooking at Chaikin Analytics. So we run a hedge fund in Switzerland, long short hedge fund. But let's say I want to find new ideas. I could go into any of our lists, but the easiest way is our screener. So the screener enables you, as we saw to screen on Chaikin Power Gauge. I'm going to start with the Russell 3000, require that the power gauge be bullish, and then I'm going to go down here and say I want to see stocks that have triggered a buy signal, any buy signal, within the last week. And then I'm going to use the two components of classic bull, relative strength, and money flow. And I'm going to filter that list of 3,000 stocks down to 57 names. But there's a lot of small cap names in there, so I'm going to say I only want to see large cap stocks, liquid, optionable stocks. Now look what I've done. I've filtered 3,000 stocks down to 11 potential names. Now I can save the screen by going in here and clicking Save Screen. And I can save these results to a list, which I'm going to do. I'm going to call it Chaikin Buy Signals. And it's going to move it over into the Watch workspace. It's creating a whole new list. Buy Signals 815. There's the 11 stocks. I can loop through the charts very quickly. But I notice that at the bottom, Visa has a buy signal. So let me click on Visa. I see that it triggered a money flow buy based on yesterday's close with the stock oversold. So now I want to go into Options Play and see if there's a high probability options trade. And Options Play is showing me that there's a vertical bullish call spread with a rating above 100, checked in green. And it's saying if I buy the 140 call with the stock at 140.76, so slightly in, they sell the 149 call against it. If the stock rallies from 140 to 149 by September 28th, 176% return, Total risk is $300. That's how quick and easy it is to find high probability options trades. So with that, I'm going to go back to the PowerPoint and make you a very special offer. And the fact that I've mastered all these maneuvers is nothing short of miraculous for me. Actually, we want to go back down here to make it easy. So everything we've been looking at is embodied in Chaikin Analytics, proven stock selection system, which gives options traders an edge. It incorporates our 20-factor model and our stock discovery engine, which finds you ideas that are similar stocks that you're interested in. Normally sells for $2,195 for an annual subscription. You can go to chaikinanalytics.com/options. But as a summer webinar beach special, because we're feeling pretty good down here, $300 discount, bringing the cost of an annual subscription to just $1,895. As John Najarian once said, if you're an options trader and you can't make the cost of a Chaikin subscription on your first trade, go back to the book and relearn what you're doing. That's a little harsh. I don't normally say that, but John felt comfortable saying it. The offer expires Friday, August 17th. Again, chaikinanalytics.com/options. Now, in addition, you get the screener that you've seen, options play module for high probability options ideas, our intraday charts, earnings alerts, and my weekly market insights with a bullish or bearish stock of the week. Tom Gentile on a webinar we did a couple of days ago said, gain the edge needed for successful trading. To gain the edge needed for trading success, Marc's proprietary algorithms are special. And plus, as a Chaikin member, you get member-only access to our weekly strategy webinar with our market strategist, Dan Russo. He's a great technician. He heads the Chartered Market Technician Society of New York. You get unlimited coaching from people like Josh Mimlin and David Shulin, including one-on-one sessions if you need them. We're with you every step of the way, and you get Dan Russo's daily morning insights with a bullish or bearish stock of the day. He picked that Philip Morris trade that was so profitable. Colgate, string of good trades. Now, as a special fast action bonus, if you subscribe by midnight tonight, we'd like to take an additional $100 off the cost of Chaikin Analytics. And for the first 6 people who call tonight, you get a one-on-one telephone session with me. I'd like to let you hear what Tom Gentile had to say at the end of our webinar on July 26th.
Yeah, thanks a lot, Mark. And you know, I was going to interrupt you here and there, but you're trading a lot of the same stocks that I'm trading, and some of them I'm seeing right off of Chaikin Analytics, and some of them we're seeing right off of our tools. So you know, it just goes to show that these two tools complement each other quite a bit. And you know, like I said, guys, you know, I've known Mark for a while. He's really one of the first outside folks that we brought into our group. He is the first person that I brought in the group that actually has a software product that I think works very well with what we're currently using. So I wanted to, wanted to bring him in, let him show you what it is that he sees, also what I'm looking at as well, and see if it might be something that would fit your arsenal of tools. So, Mark, thank you very much. I appreciate it.
I'd like to turn it back to Josh Mimlin, who wrap up. Thanks, everybody, and I hope you get the same kind of quality beach time we just got in.
Thank you, Mark. Thank you, everybody, for attending today. You can click on the link in the chat window that will take you directly to the offer page where the offer will automatically be applied inside the chat window. You can click on the link, www.chaikinanalytics.com/options, or you can call us at 877-697-6783. You get everything that Mark mentioned. We could have you on an onboard tomorrow. We do them twice a week. We record them so that we can send you a recording if you're unable to make it live. The stuff that Mark showed you on how easy it is to find these trades, you could do it yourself. We also have member sessions to help you with that as well. Myself and my colleagues run them. They're fantastic. and a one-on-one telephone session with Mark is an incredible offer. Take advantage of it now. Again, sign up, www.chaikinanalytics.com/options, or call us right now, 877-697-6783. One of my colleagues can help you out. Thank you all for attending, and I look forward to seeing you in a future members session.